Well, Kip, thank you for joining us this evening. I know our clients here and everyone joining is excited to be here. Um, and we definitely just want to make sure that everyone can see and definitely just be aware of what we have going on today. We have Kip with First Horizon talking to us today. And so we want to make sure that we give them our undivided attention because definitely, side hustles, gig work, 21st century jobs, people are doing that. And how does that relate to kind of getting a mortgage and how do lenders look at it? So Kip, without further ado, if you don't mind taking it away.
Okay, thank you so much, my friend. I just want to thank everyone for taking out time in your afternoon to join us for this call. And believe it or not, this is one of the most important aspects of the lending because a lot of people just don't know. And we're going to be talking today about side hustles, gig work, and self-employment, and qualifying for a mortgage with non-traditional income. So let's go to the next page. And I am Kip Dixon. I'm AVP of Community Development for Cadence Bank Mortgage. We were previously known as Bancorp South. We just finished a merge a few weeks ago where we purchased Cadence Bank, and we actually took on their name, and we think that'll represent us going forward in the communities that we serve. Next slide. And so, reminder, we're mortgage, we're not tax professionals. And I always want to clarify that with my clients that if it's something tax oriented, please consult your tax professionals or CPA about your personal tax situation. And one thing that we do have is we do have people on the credit side that can help you. But again, I'm not, as a mortgage lender, I'm not a tax professional. I just want to make sure that we're all on the same page there. Next slide. So one of the things that people, don't understand about self-employment, just because you may, because you don't own your own business doesn't mean you aren't considered self-employed. And what that means is, several people, these side hustles. I have a client right now that we are doing a file for. He works part-time, and this one part-time gig he does, and he does carry it on his income taxes. He files it on his taxes, and so, this says if you receive income through any of the following ways, you may be considered self-employed. So having a side hustle, participating in a gig economy, working as a contractor or consultant, owning your own business. Some examples of that is if you drive Uber. Most Uber drivers are 1099s or are considered self-employed. Or you may have a beauty salon and do hair cutting on the side. I see that on a lot of tax returns. So, and that's okay. Because if you actually are doing that and you're collecting an income, that's income. And so one thing I do want to remind people is after COVID, 30% of the workforce considered themselves self-employed, according to the IRS. So we really think that is due to COVID-19. People had to figure out ways to make income during that time frame. So let's go to the next slide. So the gig economy is in gig workers who have a primary job as well as a gig on the side. Just like the example I was using, one of my clients who hopefully will be closing in the next few weeks. 1 in 3 U.S. workers participate in the gig economy. Goes back to that 30% that we were talking about. So some of the perks can include your flexibility and freedom. And like I have some clients who are teachers during the day, and on the weekends and in the evenings, they serve as realtors. And I work with several of them because they want to make sure before they jump right into it full time that they've established a reputation and they have a steady income stream coming in before they quit their main job. So some of the drawbacks is, fluctuations in your income can be viewed as risky to some lenders. No medical or employment benefits. So, that's definitely different nowadays because you can join, get through the exchange. You can get some form of benefits, and then there's no 401k. So you have to, figure out what you want your life to look like after you get through doing your other side hustle gig, or that could potentially turn to your permanent job. Next slide. So what qualifies as a gig, a side hustle? Some examples include independent contractor, consultant. So someone could be a beauty consultant. I have my sister-in-law is a life coach. That's one of her. That's her turn. It was a gig, but turned into her permanent job. A freelancer. This is someone who does photography, graphic design. One of my roles is I serve as a Booster Club president for my football program, and I always have a graphic design artist who does our programs annually each year. So that's something that could be considered a gig, good hustle. But he makes good money, just so you know. Graphic design is a good place to go. Temporary or seasonal work. So we see this a lot when it's holidays or teachers who may work during the summer. So, those are some things that could be considered, a side hustle or gig, but could turn into like I said, a permanent job. Driving rideshare, which I spoke earlier about, Uber and Lyft. Those are some great programs where it could be a side hustle. You want to make a little extra money here. You got to some bills you need to pay. Kids in college, you don't want to help them out. And then delivery services as well, like Amazon, Instacart, and DoorDash. We're seeing a whole lot of people being able to do that and help do things for themselves. And what I spoke earlier about cosmetic, hairstylist, lash nail technician, there's so many little things that can be considered gigs or side hustles. And so like I have some clients who are doing with the Bitcoin, they're doing things like that as new ways of raising income for them and setting their family up for the future as well.
So day trader, right? That's a different gig as well. Thanks, Kit, for bringing that up.
Yeah.
Because we're going to talk about how does that talk when it comes to, accounting for it in your income, right? As a side hustle.
Oh, yeah. That's where the fun begins, and for us as lenders and what we look at. And so I just had a client who wanted to purchase a home, and she has a job on the side. And the thing is, she's been doing it for 6 months. And so one of the things we look at, we want to see at least 2 years of generating income. And
Kid,
the reason,
but Kid, why though? I make money. I'm making the money now. Why now? I make the money. You got to count it.
No. Well,
okay.
2 years, because we know a lot of people come and go. They start some and they end it. And we have to see that, because that's how we use the tax returns to calculate the income from that business. And so, some people may not even declare it on their income taxes. And so if they don't declare it, I don't know about it. It's like it's not even there.
Okay.
And so you have to do a letter of explanation about those large deposits.
Okay, so you're telling me people rather save a couple of dollars in taxes to not pay than to not get accounted for their purchasing price, right? Because that's what they're doing, right? At the end of the day.
That's exactly what they're doing. And it lowers their amount of their income that they can qualify for. And so that's the drawback to it, because they're using it as a business loss to lower their taxes that they have to pay, but then they want to buy a house the next year. And so they come and they have $15,000, $20,000, $30,000 in losses. Well, they may make 70,000, but by the time you calculate that income, you and all the other write-offs, they will end up not having that much income to qualify for the house that they want to qualify for.
Awesome.
So
And I don't want to get ahead of
And
ourselves. I know we're going to talk about taxes in a moment and how it's claimed, but definitely thank you for bringing that up. But as you see, we see here, you talk about reporting your income tax. You know, how do we calculate that, and why is it the way that it is, right? Why isn't it not 1 year compared to 2 years? Why isn't it 3 or 4 years? You know, why is it two?
yeah, the most important is because we can get an average. You want to get an average. 1 year, you don't know, but 2 years you can do a year-to-date profit and loss statement and cash flow statement, and you can do it that way as well. Because we'll see from the 2 years, and then when you come to us, we can see if the business is still valid, and look at your deposits into your business account. And that's something that I want to encourage you. If you do decide to do that, start a business account, because that helps you out in the long term when you're looking to use such to qualify. So
Okay.
lenders, like I said, we look at the 2-year average of your total taxable income. So that means total income minus the qualified adjustments. And so one other thing on this, and what people don't realize also, like depreciation, amortization, mileage, those are items that we can add back. Now, we as a lender can add them back, but every lender may have different ways of doing it. So I can only speak to Cadence Bank, but I'm able to add back income. So sometimes it may wash out, and so and you end up having, oh wait, I got more money than I thought. So some things that people can look at as if they drive their car for Uber or Lyft or something like that, you can put that in and have it being paid out of your business account, and therefore it doesn't count against your debt to income. And the mileage and the depreciation, you can use that and add back. So there are ways to do, if you're going to do it. I just want to encourage people to do it the right way.
For sure, for sure.
Okay, we can go to the next. So are you a business owner and self-employed? So again, some examples may include owning your own business, any type, or you may be the sole proprietor of a business or a franchisee. Put simply, you work for yourself and you pay yourself. And in this case, sometimes a lot of business owners are self-employed. They may pay themselves as a W-2. Again, these are people that, you may want to talk to your accountant about that. If you're looking to purchase a home, look at possibly switching over to being paid as a W-2, and look at your K-1s and how that's done as well. There's so many ways to do it the right way.
Okay.
And so accounting for self-employment income. So did you receive cash income or a form of 1099 from an employer? So what a lot of clients that I've run it had is that they don't know that they're actually self-employed. And so I said, well, did you get a 1099? And they say, yes. I said, so you're considered self-employed, but they didn't know. And they may have been a contractor or what have you. And by doing so, we have to calculate that as self-employment income. And if you receive cash, if you have on your Schedule C, if it says cash basis and you report it, that's also, we use that for income calculation as self-employed, because you'll put that on your Schedule C. Now, do you report your income on your taxes? If so, have you declared a business income or business loss? I'm telling you, that is so important to note, because some people may have Aunt Betty or Uncle Joe do their taxes, and they may put a business on there that they don't even know about, but they happen to get that $7,000 check, that tax refund, but then, they go to buy a house and they're like, I don't know anything about this. Well, you knew something was up because you got a $7,000 check. And so, if it's too good to be true, something is up. So, you may want to ask Uncle Joe, hey, what did you do to my taxes? But you can also amend them as well if that does happen. And going back to how long you have been doing this work, we really want to see 2 years. I keep stressing that. 2 years of level or increase in income on your taxes. Now, if you've been doing it 2 years and you show a loss, what's going to happen is that if the first year you had income and the second year you have show a loss, we do 24, we average the year with the loss. So that hurts you. So you always want to show progressing income if you do that. So in calculating your annual income, lenders, we will review the last 2 years of your adjusted gross income, your AGI, and the year-to-date information, which I spoke earlier about, your profit and loss statement, to support the case that your income will remain steady compared to the prior years. That is so important for an underwriter to see, is that your income will stay steady. And so deductions and write-offs. So what you need to know, those who are self-employed often take advantage of legal tax deductions and write-offs allowed by the IRS. Why not? I mean, you know, I'm not going to tell you what and what not to do. Again, I'm not a tax professional, but you know, at the end of the day, when you make a certain choice, realize that, okay, if you know you want to buy a house in 2 to 3 years, do what you have to do to be prepared for that. So this is why I like this presentation, because you're ahead of the game, where some people, they just don't know. So, you know, if you're going to go through and take a bunch of tax deductions and do a bunch of write-offs so you can get a fat check in the spring, then think long and hard about that if you want to buy a house later that year. Deductions reduce the amount of income you're taxed on. However, the amount of income you're taxed on, your adjusted gross income, AGI, as shown on your 1040, is what lenders analyze when considering a loan approval. So this is going to hold true even if you have primary employment. So I think I saw that question come in. If your side hustle gig work reduces your AGI, this can affect your ability to qualify. So let's take a look at that, how that works. So let's look at in 2018, the 1040. So if you look at 7B, that's your total income. And then you look at 8B, that's your adjusted gross income. And then 10 is your qualified income or deduction. Okay. So your taxable income and purchase power, if you file any type of self-employment on your taxes, income or loss, here's what you need to know. Your adjusted gross income, other people refer to it as AGI, will affect how your lender calculates your income. It big time how we calculate it. As a result, your purchase power, and this is something when you speak to a lender, they're going to talk to you about your purchase power and your affordability, which could be reduced if you filed a loss. This income calculation will be what's used when accessing your housing and debt to income ratios.
Correct. Yes. So let's go with the story, right?
Yes. So let's look at John. So John works full-time as a medical assistant. He is paid hourly by his employer and receives W-2 income. Additionally, John began driving Uber for Uber Eats in his free time to generate some extra cash. He filed the income he makes from his job on his taxes as well. So in 2018, John earned $50,000 from his primary job. He also reported $10,000 in income from his side hustle. When filing his taxes, John and his tax professional decided to deduct qualifying business expenses related to his side hustle. Example, vehicle depreciation. And after filing all qualified expenses, John had a business loss totaling $15,000. Let's look at a few of John's key income tax documents. And so there's John's Schedule C profit and loss. So you see the qualified expenses, which is, and that's small. So bear with me, bro, because my eyes are a little small.
That's a 10,000 right there for you.
Is that for the?
That's the business law profit and loss for the business. So for the side hustle, the gig.
Okay, so that's 10,000 right there. And so and that's considered, that's a car and truck expense.
Correct.
25,000. Your gross income 10,000. But if you look at the bottom, the loss, that's what we use, is 15,000.
Correct.
So I was looking to see if they didn't put any depreciation for the car.
Oh,
They
yeah,
didn't put any depletion or anything like that. They just put the expenses. So let's look at the next page to see. And then right here, you'll see his wages and earnings, which we spoke of. He made 50,000, but then you put that business loss 15,000. And so adjusted gross income, it went from 50,000 to 35,000. That's pretty extreme, because not me, you possibly can get a house with 50,000 with no debt, but 35,000 is going to be a stretch. And then the adjusted gross income, like I said, it goes to 35,000. So let's talk. How do you think John's adjusted gross income will be affected by filing a business loss? I guess people can put it in
the chat.
Chat.
Do you think they can pay for more or pay for less? Let us know what you guys think in chat. Now, this is really important, right, Kip? Because people say, hey, well, I make 50,000. That's just my business, right? But they don't know when they're doing their taxes, they're actually taking a loss, and that's actually pushing them back even more. So when you thought it's helping you, it's actually making it worse. So again, here at Habitat, we definitely provide HUD numbers. So, based off that 50,000, we say, hey, you can afford 3 times what you make a year. So that 50,000 means you have a purchasing price or purchasing power of 150, compared to now with the business laws, just the gross income, your AGI now with the tax return shows that's closer to more about 105, right? So that's a $45,000 difference in purchasing power that you have, just because you're trying to save a couple $1,000s in your tax returns. So that's why we recommend do not do that, and be aware of the side gig, right? If it's not paying as much or you're doing more losses, that might not be the best option. I think they're a little shy, so they're not putting anything on chat. So we'll go.
That's okay. That's
now, let me ask you, Kip, why would a lender be concerned about the business loss, for this side hustle?
Yeah, buddy. So that loss, again, we want to see that you are increasing and making money on this business. But if you have a loss, that makes it a risky loan for us, because will you be able to pay? It affects your ability to repay. That's something that a seasoned loan officer will tell you. It's your ability to repay. And those words right there, if we see in a bunch of losses, that will affect your ability to repay. And that's the first thing the underwriter is going to think about when they're looking at this as well.
Okay. Now, what if they say, what about John says, hey, I'm not working there anymore. That was just for last year. What about they give you that answer, that response?
Okay. So if that's the case, we would have to see where the business has been dissolved. We will check and see if you filed EIN with the state of Texas or wherever you come from, and make sure the business has been dissolved. So if it's dissolved, then you can do a letter of explanation and state that you started this, but you dissolved it because you want to focus, blah, blah, blah. And a letter of explanation will get you, take care of that. But we have to see that the business has been closed. It's closed shop and is no longer being reported with the state of Texas. If you're here,
yeah, we did business here, or is a different state. But
a different state.
At that point, based off the the loss of explanation, would they be able? Would you guys then, or for example, your case at Candace Bank, would you guys be able to still average out the 2 tax returns, or you guys kind of go based off the W-2 return?
We would go off the W-2, because that business, that's no longer in business. So that's not income that we can use or loss that we can use. Okay. And even if we, when we run the get your tax transcripts and see it as loss, again, your letter of explanation would go with that. And the key is to have the business dissolved, because we can say that backs up the underwriter not using that loss against you.
Okay. Awesome. So let's talk about some key takeaways.
Okay. So some of the key takeaways, more people are considered self-employed by the IRS than who self-identify as self-employed. That's what I was saying earlier. A lot of people, they don't realize that they're considered self-employed when they reach out until we had this conversation. And again, I want to encourage all of you to always review your taxes carefully before signing. Don't think about that big check you're going to be getting deposited into your account. Look and make sure that the information that's on that tax return is legit and it's for sure yours. Just so this is a side item. We've noticed a big high tick in people filing false taxes, putting wrong numbers when they complete a application, saying that they're making, they're working with people and getting false taxes to provide to us. But when we pull their tax transcripts, their income is like $100,000 less. And I had to cancel 3 files back to back because it was the same CPA. And the first time I was on alert and I told my team to be ready. The second time it wasn't an accident. Third time I said, something is going on here. We will stop using this realtor, their clients, because for 3 clients, the taxes were significantly what they showed us. Their tax return looked good. Everything looked good. They had great income. Everything looked good. But when we received their tax transcripts, not only did their W-2 income was wrong, but their tax income was wrong. So again, I want to strongly encourage you to always review what you sign on your taxes, because that's going to be very important. And beware of I just spoke of this, but beware of unlawful tactics used by tax preparers to reduce your tax liability, such as claiming a business loss if you don't own a business. Folks, I can't begin to tell you how many haircuts, barbers that I see come across my desk. And immediately we go look it up to see if it's a legitimate business through the state of Texas. And if it's not, that's when a whole bunch of questions begin. And eventually we won't end up doing the loan because we can't prove it. Now, if you file taxes on it, it's consistent, then you do accept the right level, because some people don't know, but you want to do it the right way. And overstating write-offs or deductions, be very careful with that, because that'll come back to bite you as well. And so if you do catch inaccurate information after filing, I said this earlier, you can amend if needed. Note, amending requires that you pay taxes owed that were not paid at the time of filing. So people know that they got to pay certain taxes. They just don't want to pay them. But if you're trying to buy a house, do what you have to do, suck it up, and go ahead and pay those taxes, because it's better for you in the long run. Take that short-term pain for that long-term gain if you're wanting to purchase a house, especially in this market. And so income isn't everything when qualifying for a mortgage. Your credit score, history, and savings are factored in too. So just those are the main key takeaways that we want to make sure that y'all have before we go on.
Now, Kip, I do want to bring up a few things. I had to take a note for when you said amending, you did say that does increase your purchasing power, but also I tell clients, a lot of them people dealing with debt or, credit, this does also increase your debt to income, right? Your back end ratio. So keep that in mind, that we want to be aware about that as well. Now, usually when you amend, you pay a little bit more, right? Like how Kip mentioned.
Mm-hmm. and something else, I'm glad you brought that up, is let's just say you have to get on a payment plan. So we have to receive those documents from the IRS showing that they've agreed to put you on a payment plan. You'll be paying $300. So guess what that $300 goes to? It goes to your back in your ratio, your debt to income ratio. We have to add that. And so again, that's going to reduce your purchasing power and your affordability. So again, in the short term, that $7,000 check is nice. But in the long term, when you're trying to buy a house, you're going to pay for it one way or the other. So you won't get a house so I always encourage clients to just do the right thing up front.
For sure. And I think that's why I hear at Habits, I would like to say education is key, right? You don't know what you don't know. So now you guys are learning and you're going to do better. But then also like to hit on the thing that we brought up, right? Be aware of unlawful tactics that tax preparers will do to reduce your tax bill. Again, I tell all my clients, just because someone filed taxes doesn't mean they're licensed and know what they're doing. I hate to say it, but I have to be honest. A tax preparer is not an accountant, is not a CPA. And we heard it from Kip. Some CPAs that are trained still do unlawful things. So we want to make sure we're crossing our T's and dotting our I's. So just make sure you're looking at it, because if let's say the IRS does audit you, again, we're not talking about taxes, but if they do audit you, they won't come for your tax preparer. They won't come for their business. They're going to come for you, because you're the one that's signed on the dotted line saying, hey, this tax return is mine. I agree to everything that's on it. And so if you owe money, they're going to ask you to pay it, not their tax preparer. So just be aware about that, guys. Okay. And we'll make sure we bring that up as well.
Yep.
All right.
That's
so,
a good one.
So, Kip, let's go into some resources that people have.
All right. So one thing that if you're in doubt, reach out to Habitat, the homeowner counselors. Man, they are a great resource. They have the knowledge. They've been at this for a while. And if they don't know, they will find someone on the team that can help you. So you got them right at your fingertips. So another place is VITA, Volunteer Income Tax Assistance. Look them up. It's a volunteer. You don't have to pay anything, and they can help you. PocketWise Cafe, which is a mortgage calculator and other free financial tools. That's a really good location as well for some information. And also me, if you have questions before you even dive into it. I got clients right now that I'm working with, and I know that we're a year away, but it's because we know what we have to do, and we're working on that. So
thank you, Kip. So we do have a section for Q&A. We'll give a few people a second to kind of put anything on their chat. But I do want to ask you, Kip, what is something you wish clients knew before they came into when it came to trying to get a loan with you, right? If they didn't go to counseling, they're just applying, coming into your bank or reaching out to you by phone, what is like say, hey, you need to have this document ready, or hey, look at this before you come see me, or what is some best practice that you say you should have done this before you came in?
Yeah. Some of the most important practices I want to tell clients to, make sure they have bank statements that don't have a large cash deposits in them. Nowadays, I'm seeing a lot of Zelle transactions, and it's easy to not think about it. But if you make a certain amount of income, the underwriter is going to take a percentage of that deposit, and if it's over a certain amount, you got to trace it. You're going to have to do tell us where that 1,000 or 2,000 or 3,000 come from based off of your overall income. That's one thing that I'm seeing a lot that I hadn't seen in years, but now I'm seeing a lot of Zelle transactions going back and forth. The other thing is, make sure that if you're going to do a second job, we want you to work at least show 2 years consecutively of working more than one job at the same time, so we can count that income. I had a client who recently, makes really good money on her second job, and she's been there 6 months, but I couldn't use it because I said, do you have a history of working 2 jobs? I just need to show a history of 2 years consecutively that you worked 2 jobs before, and she can do that, so I can do the loan. Okay. So those 2 things, and have an idea of where your credit is. When you're getting ready to purchase a home, there's so many free sites that you can pull up to get an idea of what's on your credit. The credit scores may not be what it's supposed to be, but you can still see what's on your credit without having your credit ran. And the 4th thing is, don't have everybody and their grandma running your credit these days. Credit is tightening up. So you don't want to be running your credit buying, a jeweler here, photographer there. You applied for a house. You went and had you're shopping for a car. And you went to Nebraska Furniture. You're looking for some furniture. You're all over the place. And so DU is not going to look kindly on you. That's desktop underwriting. That's the AUS automated underwriting system is not going to look at you favorably on that. And so, because you don't want to have a bunch of hard hits on your credit. If it's not, some people say, well, you can do it in a certain time frame if you're looking for a house. I can't say anything to that, but I always tell people, if you know you have a 620 and we need a 620, don't have everybody running your credit.
Right.
So
Awesome, Kip. Now we did have a question. Someone said, what if I do get paid through Zelle, Cash App, or PayPal, right? Is that going to hurt me, or is that just kind of the way I'm running my business? Because that's just a way of a POS, right? Payment system that they use.
Yeah, it's a payment system. So that's just how you get paid. And that's when because I literally just closed the house. That's why I brought up Zelle. Close on a client who, that's how he gets paid. The clients pay him through Zelle. His vendors, he pay his vendors through Zelle. And we could track that because we had several months of it. I think we did 12 months of his business account. And that's why I tell people, start your business account, separate it from your personal, and show that you're paying in, and you're paying your contractors as well as you're receiving income. So when you go to your CPA and have them do a year-to-date profit and loss statement, it's very simple for them.
Okay. Now, someone did ask, what if they put, again, nothing to do with the target. What about if they have money cash and they put it in a savings account? Does that hurt them if they're just doing it right before they apply? Or should they have that money in there for a couple months, or, would that raise some red flags or some questions for the lenders?
Okay, so this is what I was told when I was starting this several years ago. I'm not going to give up my age, but if you have cash, and a lot of us like to put cash in walls and the deep freezer, my grandmother liked to put it where, in her bosom. It is what it is. And so, but I always tell people, if it's your cash, put it in your account and let it season for 60 days. 60 days. Just go ahead and put it in your account. If you know you're not trying to buy in the next 60 days, go ahead and put it in there and be strong enough to not touch it. So if you know you cannot not spend it, create a separate account with your same bank account, another savings or what have you, and you name that account, this is for my house savings account. And you set it there and you leave it there, and because each time you want to touch it, like that when you see those words, it's going to keep you from drawing from it. And so, but let's just say you found a house and it's 30 days or so, 38. So let's just say your mom, a dad, a grandmother, a brother, or sister that you trust wholeheartedly, it requires 30 days seasoning, and they can write a gift. So you have those two options if you have cash. And so, but I'm more of, create an account, put it in an account, and just don't touch it, and name it your housing account.
Okay. And then I think this is the last one here we have is, what about if I'm a student and just graduated? Do I still need to have 2 years of tax returns for my job, or can we use some other source?
Students are some of my favorite clients. All we need is, because it's amazing. A lot of the programs, the students don't realize that they qualify for so much, because they're just starting their careers, and we can use their diploma and their transcript and show that they've been in school that time, because that's work. Mm-hmm. I don't know about you, but I was working like a dog when I was trying to pass my classes at UT. Yeah. And so that's considered work. So we can use that. And then and the job that you're on, as long as you've been there a month, then you'll be good to go, because we'll need 1 month of pay stubs.
Okay. Awesome.
Well, Kip, or a contract if you're a doctor. So.
Oh, okay. Well, Kip, thank you so much. It's been amazing, guys. Definitely let Kip know in the chat that he's amazing. Kip, how can they reach you, and how can they get out to you if they have questions or kind of contact you?
So you'll see that's my work cell right there, my work number, and then my email is probably the best way to reach me at first, because I get that boom, boom, boom. Now my work cell it goes to it's my work number, but I have it go to a cell phone, but that cell phone may not be on certain times. So that's why I say email is the best way at first. And all you gotta do is say, hey, Kip, I attended this class, and then that'll jog my memory, and then boom, we'll get going. And I'm always available for any questions. Don't I'd rather you know, even if you're not going to use me, if you're going somewhere else, because everybody, you may see a program that may fit you and your family better than what I have to offer. But I still want to help you and make sure that you are set up so you can become a homeowner. That's my ultimate goal.
Awesome. Thank you, Kip. That's why you have you as a partner, because you are one of the best. Thank you guys all for joining. Just want to let you guys know again, my name is Christian here with Habitat, one of the counselors here.